I just got my semester test back. It wasn't looking good.
Yeah, it was really bad for me too, Aisha. I felt like that question was the first time I'm seeing it.
Are you serious?
Yeah.
What about you guys? Did you guys do okay?
I thought it was okay. Yeah. Was it the revaluation question?
Yes. How come you're so well educated? Tell us some more, man.
Basically what you have to do, let's just say for the netcare question that we got, what you had to do is you had to first go through like a 4-step program whereby you draw your timeline and then you calculate the taxable and the depreciable amount of the asset, and then you do your analysis. Then after you do your consolidation journals and your disclosure. So the most important thing that you need to keep in mind when you're doing that is that with a depreciable asset, if it's revalued, you need to use the new amount to calculate everything. Understand? And you should also keep in mind that you should check if the subsidiary has recognized the revaluation asset in its own books.
Okay.
Yeah.
That actually sounds okay. Tell me some more.
We have here, it's Netcare Limited. It's a holding company which acquired 60,000 ordinary shares in Sub Limited on the 1st of January 2021 for 120,000. At this stage, the share capital of Sub Limited was 100,000, R1 per share, and the retained earnings was 100,000. In the books, the cost of the vehicle was 75,000. The accumulated depreciation was 25,500. So when we minus that, you get a carrying amount of 52,500.
So how the depreciation table works, or the calculation table, is that you'll take the revalued amount, which you'll get from taking 52,500, subtracting the 49,700 to get to an amount of 2,800. What's important to note here is that the 2,800 Rand is in brackets in your calculation table because you revalued your asset, your vehicle, we revalued the vehicle at less than the carrying amount. Then secondly, then you take it to your tax at 28%, then you get your net amount. And then you've got your depreciation for the first year. How to get to depreciation is that, as Aubrey mentioned, we did 10% per annum. We worked on 10% per annum, which in the end is 10 years useful life. We've already used, I don't know if you can say it like this, 3 years because of when you determined it, when you use the 10%. So we take the 2,800 and we divide it by 7. We get that to equal 400. That is your depreciation amount. And then, of course, you times by 28% and then you get your net amount. The same can be done for the depreciation for the second year for 20.2. Then you've got your carrying amount of 2,000, which will still be in brackets, times your 28%, which is 560. Then you get your net amount of 1,440. Then your depreciation for the year of 20.3 will slightly differ because we sell the asset on the 30th of June. So you'll take your amount of 2,800 divided by 7 years times by 6 over 12, and we'll get an amount of 200 Rand. Then we'll take that, times it by 28%, then get your net amount. Then we've got a profit of 1,800 Rand, the tax at 28%, which is 504, and the net amount at 1,296.
Onwards to the analysis of owner's equity. First, we're going to have our share capital at 100,000 as it's been given, and then for the retained earnings, and this is where the catch is. We're going to put in our original retained earnings of 100,000, but we're going to remove the revaluation deficit of 2016. Moving forward, we're going to have goodwill because we paid 120,000 Rand for this subsidiary. But everything considered, it was 118,719, which leaves us with 1,210 Rand in goodwill. And then since acquisition, it gets more interesting. We're going to have the balance, but that doesn't matter in this explanation. What does matter is this. I'm going to subtract 100,000 Rand from it, which is the add. And then moving on, we're going to add depreciation after tax of 576. And we're also going to add this to our retained earnings. And then that brings us to the current year, the present, no place to be. Then our depreciation after tax, the final one for this year of 144,000. We're going to add that. The profit on the sale of the asset, we're going to add that at 1,296. And that's the analysis. Real easy.
For the revaluation of subsidiaries vehicle at acquisition, we're gonna debit retained earnings with 2,016, debit deferred tax with 784, and then credit vehicles with 2,800. The acquisition journals, as per the analysis, we're gonna debit retained earnings with 97,984, share capital with 100,000, goodwill with 1,210, and then we're going to credit non-controlling interest with 79,194, and investment in sublimited with 120,000. As you can see in the calculation table, there has been depreciation for 2 years that amounts to 800 in total. So from acquisition to beginning of current year, we're gonna debit accumulated depreciation for vehicles with 800, and then credit retained earnings with 576, and since we're taking tax into consideration, we're gonna credit deferred tax with 224. Depreciation for the current year is 200, so we will debit accumulated depreciation with 200 and then credit depreciation with 200. The tax implications for depreciation for the current year is 56, being 28% of 200. Therefore, we will debit income tax expense with 56 and then deferred tax with 56 as well. Due to the sale of the vehicle, we're going to have to adjust profit on the sale of the equipment. So we will debit vehicles with 2,800 and then accumulated depreciation with 1,000 and then profit on sale with 1,800. Due to the profit made from selling the vehicle, we're gonna have to consider the tax implications. Therefore, we'll debit income tax with 504 and credit deferred tax with 504.
So with regards to the consolidated statement of profit and loss and other comprehensive income, this is like a basic one relating to our actual question. So here, when I say calculation 1, we relate it to the only thing from our calculation table that's going to affect this is going to be the adjustment to depreciation from our calculation table, which is at 200 Rand. Then also it's going to be our pre-tax profit, which is going to be the 1,800. These amounts from the income tax expense, because obviously once we're doing depreciation or once we revalue an asset, it will affect your income tax expense. So then it will be that 56,000 and it will be that 504,000 from your calculation table. I'm going to put your calc table. Then you have the part of the profit that's attributable to the equity holders of the parent, which will be your balancing amount from using the non-controlling interest from your analysis. Then we've got the consolidated statement of changes in equity. Your revaluation amount doesn't affect much here except for your non-controlling interest. So this is the only place it will be affected. Whereas if we had started with a revaluation surplus, we will have a revaluation surplus column here. But in our question we didn't have one, so just keep in mind about this fact. And then lastly, we've got our consolidated statements of financial position. With our consolidated statement of financial position, we've got assets, then your non-current assets. This will be your balancing amounts of your PPE, your property, plant and equipment. The only thing here with your non-current assets that will be affected is your goodwill, which we have calculated it in our analysis. Then we've got your current assets, then your total assets. Then you've got your equity and liabilities. Then your total equity, this will be your equity attributable to the equity holders of the parent. So the issued ordinary share capital will be only that of the parent. It's got nothing to do with the actual subsidiary. Then your retained earnings, also it wouldn't have affected it because we've already recorded it and it's already been changed. Then we've got the non-controlling interest, which as again is as per analysis.